Hello, and welcome to the next installment of Diversified's quarterly investment review and economic update. My name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. As we do every quarter, we like to get together and recap really the last 3 months in markets, in the economy, and then how that translates moving forward. So, where have we been for the first 9 months of 2021? Equity markets have continued to push forward. The MSCI All Country World Index, which is really our proxy for global stock markets, is up still about 11% on the year. When we dive deeper, we see that US large cap has led the pack, followed by US small cap, international developed, and emerging markets. The bond markets had some headwinds this year, driven by inflation and the Federal Reserve, down about 1.5% this year, although not much has changed over the last 3 months. We still look to bonds to be the stable part of our portfolio where we draw income from and that provide diversification. We just have to understand the expectations given the environment we've been in over the last, say, 18 months or so. So as we look to really recap what's happened over the last 3 months, we've seen equity markets, like we said, continue to push forward. We saw some volatility within emerging markets driven by Chinese regulation, so the changes to how they regulate big tech, along with after-school tutoring, along with some of the issues with property developers having excessive debt loads. All of that has combined into some volatility within emerging markets, mainly within China, which is the leader of emerging markets. But overall, we've seen equity markets continue to push forward globally. We always crack up. It's important to think about headlines at any one point in time, right? These news organizations, they're driven by clicks. They want you to click on it. So investors a lot of times get spooked. And we like to talk very candidly about what the risks are in the market. There are plenty of headlines. We understand that investors have to know that right now is no different than 3 months ago, than 4 years ago, than 2 decades ago. There's always going to be news headlines of issues in the markets. Inflation, the debt ceiling, US-China trade relations, Chinese regulation, rising energy prices recently. There's always headlines, there's always things there to spook you. That's no different than today, right? If we look at energy prices, I actually put a chart on the screen to show coal, natural gas, and oil over the last several years. What you see is energy prices have, after they bottomed, have really risen over the last short period of time. There's a supply issue. There's no question that energy prices as we go into winter here are going to be a little volatile, probably going to be elevated, and are going to dominate headlines. But we've seen that over the last 3 months really come to fruition and something that we have to keep an eye on moving forward. The labor market is something that we see get a lot of headlines, is something that we talk about a lot because it's important that the labor market and people are back to work and the labor market improves. If you recall, April 2020, unemployment peaked around 14.8%. As of September 2021, about 18 months later, we're down to about 4.8%, about a 10% reduction in unemployment. Labor costs are rising for employers. It's something to keep an eye on. Employers are having a hard time finding workers. So we expect the labor market to continue to improve. But we have to keep an eye on what those input costs are for companies and how that affects and ripples through the economy from there. And then I mentioned it earlier, the 10-year bond yields, especially the 10-year and the 30-year bond market, they're driven by expectations around what the Fed's going to do. But beyond that, what inflation's looking like, what unemployment, what GDP growth looks like, those types of economic indicators help drive bond yields. And given the environment, we've seen bond yields go from 0.9% for the 10-year up to 1.6. That means investors who own a 10-year bond, that would be your 10-year expected yield on an annual basis for that bond. So bond yields have risen, which presents interesting challenges for some parts of the market. Is a tailwind for some and a headwind for others, just something we need to take into consideration. So I just mentioned a bunch of headlines that are driving the news cycle, especially financially, from an economic standpoint. We're seeing elevated stock prices. We're seeing inflation, a debt ceiling issue, Chinese relations, Chinese regulation. So why invest in equities at this point? One, beyond the point that timing the market's very difficult and we need to have a long-term perspective, I think the short answer is corporate earnings. If we're giving a reason today, it's corporate earnings. On the screen, you're going to see a relationship between earnings per share of the S&P 500 and stock prices of the S&P 500. They work in tandem. As earnings move forward, so do stock prices. It's very intuitive, right? As companies make more money, they become more profitable. The value of that company increases. Today, we look at the stock market and see a very healthy earnings backdrop. We're in the middle of really the beginning phases of the Q3 earnings season, and we're already seeing the announcements of very strong earnings. We expect that to continue in 2021 and then have a tailwind into 2022. Earnings are very strong at this point, and we believe that that provides a backdrop along with a Federal Reserve that's very accommodative and transparent for equity markets to continue their ascent forward. There's going to be choppiness, but we're just taking a long-term perspective, and we don't see any major headwinds today. So what are our expectations moving forward? We do think economic growth will continue to be very strong. We just think it's going to be at a decreasing rate. We do think economic growth has probably peaked here in the US, and that moving forward, not that it's going to be decreasing, but it's going to be increasing at a decreasing rate. So it's important to remember that even though the headlines may say the US isn't growing as fast, it's still growing, and it'll probably begin to fade down to a more sustainable level moving forward. And we do, as I just said, expect corporate earnings to continue their strong ascent. We do think that these earnings are going to be a strong backdrop to warrant the high stock prices that we see today. We do expect the Federal Reserve to begin their tapering program here in November. They've been very transparent. This has been extremely well telegraphed. Markets hate surprises. This should not be a surprise. Jay Powell has been very forthcoming about what they're seeing, what they're trying to do. All signs point to them beginning to taper their asset purchases, which doesn't mean that they're not pumping money into the economy. They're just pumping it in at a decreasing rate. We expect interest rates to begin to become something on the table as an increase late next year in 2022, if not early to mid 2023. We still think we're a little bit out from that. We do expect energy prices to remain elevated. There are concerns about Europe, the natural gas shortage, and the need then to flip to oil. We do expect natural gas and oil prices to remain high. And really what that ripples down to is talks around inflation are going to stay there. They're not going away anytime soon. We do think markets are going to remain volatile. They're going to remain choppy. Whenever you have headlines like this, whenever you have a point in time when stock prices are elevated, markets a lot of times look for reasons to sell off, to reprice themselves. Keep a long-term view. They're going to be choppy. We said this 3 months ago. We don't expect that to subside. You're going to have points in time where political headlines or economic headlines cause some choppiness. Keep focused on long-term, not the day-to-day in the news cycle. And then really, what do we need to keep an eye on moving forward? The debt ceiling is probably number one from my perspective of just a potential tail risk. Come December, the U.S. Congress has to decide on raising that debt ceiling. There was a bipartisan agreement to push this decision to December, but in December, at the end of the day, it's likely going to have to be a partisan decision and a partisan agreement. So that needs to be rectified in order for the U.S. to not default. We think it's a very low probability that this becomes a major issue, but it's just something to keep in the back of your mind and understand when investing in markets. Like I said, it's a far tail risk. It's just something that we want to make sure we're cognizant of as we keep an eye on everything in the economy and the markets. As we move forward and how we're positioned from a portfolio standpoint, we still like stocks over bonds. If we're making a choice of stocks or bonds, we prefer stocks. They carry more risk, but they're more reasonably priced at this point in time. Within stocks, we do like U.S. large cap. more so than any other area of the market. We just see the earnings backdrop as really strong. We think that US small cap has already recovered much from the COVID pullback. We also think that it gets a little bit more volatile as time moves forward and as interest rates potentially be put on the table. So we're leaning towards US large cap. Internationally, we're pretty neutral to international relative to the global market. We're underweight international developed. We just see better opportunities here in the US. Emerging markets, we like it long term, but in the short term, we've reduced our allocation there just because we want to see Chinese regulators kind of put out all of their thoughts here, market reprice itself, and let us focus then on long term. So in the short term, we're dialing back emerging markets. We still think long term there's opportunity. Within bonds, we think that investors need to have some government bonds for protection against equity market risk. However, we're looking outside of government bonds, especially long-term government bonds, for opportunities. We're looking at areas like high yield, emerging market debt, even preferred securities, which are a hybrid stock or bond type of security. We're looking to these types of areas to add value, to add yield. Bonds are expensive, so we're trying to actively manage our portfolio and look for opportunities that can take advantage of cheaper areas of the bond market. So we're staying well diversified. We don't think there's a high probability of defaults within the bond markets, which is a reason why you would avoid some of the higher risk areas of the bond market. We're using those areas as opportunities while still maintaining our core allocations of very high quality corporate and government bonds. We're also remaining a little bit what we call shorter duration. All that means is we're becoming less sensitive to interest rate rises. If interest rates do rise, our portfolios will be less affected. That's what we want to happen because we think the risks to our portfolio are more to the upside than the opposite way. So really, in summary, equity markets have continued their broad-based rally. They've continued to push forward. We've seen cyclical sectors, the value sectors like energy and financials, really lead the way this year. We've seen the Federal Reserve remain really accommodative. They've kept interest rates low. They've kept their asset purchase program. We expect that to unwind a little bit. So we expect the tapering to start in November, and we still think interest rate rises are well off to the future. We think investors need to just be cognizant of supply chains, rising energy prices. You know, the supply chains, you hear all the stories about the ports around the world where boats are just sitting on the sideline because they can't get unloaded. You're seeing input prices rise. We're seeing labor input prices rise. What we're really cognizant of is when these earning announcements come out, what are company management, what are they saying about their input prices? What are they seeing? By and large, supply chains are their biggest concern. How is that going to affect our portfolio? And that's how we have to be thinking moving forward. But what we see from a portfolio standpoint is we still like stocks over bonds, although we still believe that your risk tolerance should decide that dynamic. We still like US large cap relative to the rest of the world stock market. We do think emerging markets are an opportunity long term, but we're just reducing that for the short term. Within our bond portfolio, we're just making ourselves a little less sensitive to rising interest rates. And we're also just looking for areas outside of government bonds, which has been a theme for some time now, like areas like high yield, emerging market debt, preferred securities, bank loans, things like that that offer diversification, offer a little higher yield, but we're still keeping the core part of our portfolio in those high quality bonds, just so we have equity market diversification. So that's all for me today. I know I go through a lot here. If you ever have any questions, don't hesitate to reach out to your planners. We'll certainly link up and we'll get you an answer on anything you may have questions on. But as always, we appreciate your business. We appreciate your partnership. From everybody here at Diversified, stay wealthy, stay healthy, stay happy. Take care.